Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. The U.S. equity market rose to record highs ahead of some big tech earnings. And at the same time, there appeared to be some strong conviction on the Fed cutting rates Wednesday, but also telegraphing a lot more rate cuts in the future. And all of this is happening while we have the impending meeting between Presidents Trump and Xi on Thursday. For a closer look at markets across the Asia Pacific, I'm joined now by Bloomberg's Mark Cranfield. He is our MLIV strategist who joins from Singapore. Thanks for making time to chat with me, Mark. I'm curious to get your take on how you're reading the tape today and where you're focused.
In several places. Let's start with Scott Bessent, who has been joining Donald Trump on his Asian tour, and he made some comments on social media today which are very much directed towards the Bank of Japan and everything going on to do with Japanese policy. So although he was trying to choose his words very carefully, talking about exchange rates not being too volatile, and essentially the Bank of Japan being allowed to get on with its job. So although he tried to avoid specifically saying that they should hike interest rates, people know that from the past, Scott Bessent has said that he thinks the Bank of Japan is behind the curve in terms of raising interest rates. So traders can read it pretty clearly. So the yen is stronger, Japanese yields are higher. They see it as clearly trying to persuade Governor Ueda that although an interest rate change is not expected this week, there is a December meeting to come. And people do think that it's an opportunity when there's a press conference this week that Governor Ueda will use that time to prepare the markets that interest rates are going to be raised before the end of the year.
So do you find it curious that we've got the yen trading stronger against the dollar? We've got a 151 handle right now, and yet Japanese equities are extending into record territory.
There's a high concentration within the Japanese equities, and part of it is the NVIDIA AI story as well. So we're getting a little bit like what you've seen in the United States, where a few very key megatech stocks are driving the Japanese market in a similar way to what they are in the United States. So the breadth is not very good in the Nikkei right now, and it's outperforming the Topics Index by quite a way. In some respects, that's not a healthy sign because it could reverse quite quickly. But for the time being, nobody wants to call the top in Japan for the same kind of themes which are driving Korea, driving Taiwan, and driving the US as well. People just love the AI story. And when you have NVIDIA heading towards a $5 trillion market cap, then everybody else looks relatively cheap in comparison.
Yeah, right. So I'm wondering about whether or not we really need to place BOJ policy in the context of what's happening at the Fed. I mean, we're expecting a rate cut tomorrow, Wednesday, U.S., 25 basis points. The balance sheet may be a separate issue, but there is the expectation that the Fed is going to signal that more rate cuts are on the way. So put that kind of up against what the BOJ is dealing with.
Well, if I think the balance sheet reduction one actually is quite a big deal. If you get an interest rate cut, you get relatively dovish guidance, and at the same time, the Fed signals when it will stop reducing its balance sheet. That's like an additional interest rate cut at the same time. If the BOJ this week can sound a bit hawkish, those two together, it would make sense to traders to say, let's sell dollars, buy yen, because that would be the clearest macro trade to do. If you've got two central banks going in opposite directions, it would play out most likely through the foreign exchange rate. So by the end of this week, we could have the alarm bells ringing in the foreign exchange market saying that dollar yen clearly has downward momentum. But we do need the Bank of Japan to fulfill their part. And frequently, they have disappointed from that point of view. Governor Ueda has not always stepped up and used an opportunity to prepare markets for an interest rate hike when the door is wide open for him to do so. And Scott Bessent has given him a clear opportunity here to prepare markets for a rate hike.
Let's turn our attention to this meeting of Presidents Trump and Xi on Thursday. Earlier, the Wall Street Journal had reported that the U.S. would roll back some tariffs on Chinese goods if Beijing were to crack down on the export of chemicals that are involved in the production of fentanyl. Is the market right now of the opinion that these tariffs will be rolled back in the near term?
Yes, I think people are going into it with a pretty optimistic outlook. You can see that equity markets are doing well. Currency markets are relatively benign. There's nothing much happening in the US Treasury market either. Everything is pointing towards the fact that people assume this meeting will go through with no major repercussions. There won't be a fallout. It will generally be an agreement which people can see as taking things a step forward. That's really the key from an investor's point of view. It doesn't have to be dramatic. There doesn't have to really be very big decisions made. It just needs to move things slightly forward and not backwards. That the huge risk to financial markets globally is that somehow Presidents Trump and Xi do not see eye to eye, and they say that this meeting effectively was a waste of time and we're going back to the drawing board. Any signaling to suggest that they can't agree and they don't want to continue discussions, that will be disastrous for financial markets because it is not priced in at all. People have a blue sky scenario. They do not see much downside.
Before I let you go, I want to talk about inflation in Australia because we had a CPI print this morning, and next week it's the RBA decision. Where are we right now in the inflation landscape there?
It came as a bit of a shock to people. I think people were expecting a pretty much in-line CPI number. It came in much hotter than expected, particularly for the trimmed mean, which is the one the central bank looks at the most closely. There is zero chance of the RBA changing interest rates next week. And the way things are going, it looks as though they're going to be on hold for a long way into the future. There was some expectation that they could do one more interest rate cut. That's really off the table now. This inflation data is way too hot for the central bank to consider lowering interest rates again.
Is it an anomaly, or is there some conviction in the market maybe that this represents a new trend?
We had from the RBA speakers recently, there were warning signs that they were a bit uncomfortable, that some domestic factors were pushing inflation a little bit higher. But even for the RBA, this will probably be a slight surprise how much higher it came in. So clearly, whatever the RBA was seeing in their private data, it's now coming out into the public domain. And people will be very wary because this is a turning point. It's a very good sign, of course, for the Australian economy. But clearly it means that if you're a bond trader, you've now got to think much more hawkishly than you were before today's numbers came out.
Mark, we'll leave it there. Thank you so very much. Mark Cranfield, Bloomberg's MLIV strategist, joining from Singapore here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. So we had a rally in the world's big tech stocks in the U.S. during the last session, and it sent the equity market to all-time highs. The cornerstone of this advance is the notion that AI will keep driving earnings for this group, the Mag 7, right? Today, we heard from NVIDIA CEO Jensen Huang. He said his company's latest chip, that would be the Blackwell processor, is on track to generate $500 billion in revenue. Here's Huang.
We're going through a natural transition from an old computing model based on general purpose computing to accelerated computing. We also know that AI has now become good enough because of reasoning capability, research capabilities, its ability to think. It's now generating tokens and now generating intelligence that's worth paying for.
NVIDIA shares today were up 5%. And if you're wondering, this company now has a market cap of more than $4.8 trillion. Its shares, by the way, are trading at 44 times forward earnings. So Wednesday, Thursday this week in the States, we'll hear from 5 big tech names accounting for about 25% of the S&P 500. We'll hear on Wednesday from Microsoft, Alphabet, Meta. Thursday, it's Apple and Amazon. Let's take a closer look now at what we might learn. Scott Ladner joins us. Scott is the Chief Investment Officer at Horizon. Scott's on the line from Charlotte, North Carolina. Thank you, sir, for making time to chat with me. I think the big question here when it comes to mega cap tech is whether the money that we have seen spent on CapEx, and we're talking billions here, whether it's really ultimately going to pay off. What do you think?
Yeah, Doug, and this sounds weird, but billions might not be the right number of zeros to add onto this. So, we're probably talking in the trillions here. Look, if you listen to Jensen, his numbers, he thinks there's about a $5 trillion capex spend to get AI really sort of operational throughout the economy globally, and that's that is as weird as it sounds, Doug, that's actually maybe reasonable. And so that is obviously driving all sorts of not only kind of infrastructure plays inside the market, but it is driving earnings across a broad swath. Not only in the AI companies and the hyperscalers and chip guys, but these things are going to have knock-on effects to other industries. Eventually, we're not there today, but this is this capex cycle related to not only AI, but sort of more broad is probably one of the driving forces for the market. We think not only for the rest of this year, but most of 2026 as well.
So we spoke to Jensen on the sidelines of the company's presentation today in Washington, D.C., and one of the questions that our reporter asked was, where are we in an AI bubble? First of all, is that a fair term to use? Can we talk about the possibility that we're in a bubble?
Nope, we're not there. Look, I think we can talk about the possibility and maybe even the probability that this thing ends in a bubble. Transformative technology does tend to end in manias. We've seen this over and over again. Especially in the United States over the last 150 years. But to call this a bubble today, I think is just it's not probably appreciative of how much money these guys make and sort of like what the valuations are on some of the companies that if you talk about a bubble, you have to start talking about which companies are we speaking of, and the ones really that folks tend to point to have multiples that are sort of reasonable based on their just astronomical growth rates and their astronomical revenue projections and revenue not only projections but revenue sort of compounding that they've been able to deliver over the last 5 years. And so I do think this thing probably ends there. But to call to that today is probably it's probably not a fair characterization.
So I mentioned a moment ago, Scott, that NVIDIA right now is trading at 44 times forward earnings. That doesn't concern you?
Look, I'm not saying, and I should probably preface this, Doug. I'm not saying any individual name might not be in bubble, and NVIDIA specifically is one that we should probably worry about some because their valuation is based on the moatness of their particular AI chip, and all it takes is look what we saw it in DeepSeek. When that got announced, and it didn't really react to the Qualcomm news of earlier this week, where they're saying maybe they have a chip that can compete with NVIDIA. But at some point, somebody's going to figure out how to make a chip that really competes with NVIDIA, and then we do have valuations questions about NVIDIA specifically, but the group writ large, I think there's still quite a long way to go. So
let's change gears, move away from earnings, talk about the Fed because we have a decision on Wednesday afternoon here in the States. What are your expectations? House view is quarter point, right?
Yeah, House view is quarter point, and it's pretty. Look, that's a pretty solid House view. I mean, it would be absolutely shocking for them to do anything outside of that, and because we know the Fed doesn't like to surprise markets. They've been setting the markets up for this 25 basis point cut, and probably another one as we come into December as well. That's almost fait accompli. That's not really where the interest lays in the meeting this week. Really, what folks are going to be looking for, Doug, is going to be more talk around, are we done with QT? Is quantitative tightening program has this finally come to an end? Have we got the end of this cycle? But as we think the answer to that is likely yes. We think that the sort of just the risk reward framework that the Fed tends to operate in is sort of a risk minimizing framework, and we are getting towards levels in the repo market that should not concerning yet, but they don't want to fly too close to the sun again like they did in 2018 and risk sort of money market troubles and sort of the function of the financial system troubles. So it probably makes sense for us to get to end QT. We think that's the announcement that's the announcement we're going to get, and even though that should not really be bullish of risk assets or anything like that, we think the market actually may react in a bullish way on the back of that.
So at the same time, we had recently a couple of difficulties, let me put it politely, in the credit market space, a couple of blowups there. It's kind of interesting that you get those types of situations in an environment where interest rates are declining. What does that say to you?
Well, I mean, it says that people can still make mistakes, and there are still going to be individual credits, individual companies that do things that are somewhat nefarious, or they lie, or they hide debt. I mean, these particular instances were looked like companies just bad actors, like guys doing bad stuff. What it does not seem like it is endemic to any sort of systematic issue inside of markets. And look, Doug, it's really hard as you and all of our listeners know, it's really tough to get a systematic credit event when the economy is bumping along at 5 or 6% nominal GDP growth, without, frankly, a whole lot of private leverage in the system. And so, we are, look, we're paying attention to this stuff. We think it could crop up and certainly in some of the private markets, probably a little bit more worrisome than public markets. But it's not, this is not sort of any systematic issues that we're really worried about, because the underlying economy is still pretty darn strong.
Value is such a tricky term to use. Is there any left in the market right now, do you think, to find?
Yeah, look, if you get, I think, yes, as odd as it sounds with valuations, quote unquote, where as expensive, we don't actually think valuations are that expensive. We think valuations are fair where we are right now, because we think we are on the cusp of one of these productivity booms. And if we are, then the sort of the natural rate of growth and sort of the inherent rate of growth in the economy is going to be boosted by 150 basis points over the next 5 to 10 years. And that, and that changes everything, because the compounding effect of a meaningful boost to growth inside this country, and really globally probably, it means that you are going to get higher revenue, higher sales, higher earnings than anybody has in their discounting models. That means that what you think is a 22 PE today may end up being, when we actually realize it, may end up being a 15 or 16. But that is predicated upon the idea that we are going to get faster than typical growth based on productivity shifts, emanating out of the AI technology. So look, there's a daisy chain of logic there that has to end up kind of working through the system. But if that's right, this is not an expensive market. This is a fairly valued market.
So as we're speaking, I'm looking at gold just under $4,000. I mean, we had record highs, I think, last week, and I'm wondering how you're making sense of the volatility lately. But a high gold price like that, $4,000 an ounce, has to tell you that people are concerned about something. I mean, that's kind of what the old school playbook would tell us, right? Is that not the case? Are gold investors worried about something that we need to kind of discuss a little bit?
If we're going to do the read-through on gold prices to some sort of systematic risk event, like you would want to see that come up in other asset classes as well. Everybody's talking about gold and silver and sort of the metals as being sort of like the first step on a kind of a debasement trade, or we don't trust. And debasement trades, let's face it, are just, we don't trust the government. We don't trust you guys anymore. We saw it in the UK with the Liz Truss experiments, where both their bonds and their currency sold off simultaneously. That's the kind of activity you would get in markets if it was a true debasement trade, where markets say, I don't believe you anymore. I don't trust you. I don't want to hold your stuff. I only trust something like gold or silver or something like that. The fact that we didn't get a sell-off in U.S. Treasuries, which is the biggest asset class in the world, associated with the simultaneous rise in gold and silver prices, doesn't exactly lend credence to the debasement idea. We didn't see a broad-based sell-off of the dollar. That also does not lend credence to the debasement idea. And we saw Bitcoin actually sell off at sort of the same time, or at least go sideways, while gold was skyrocketing. And so I'm not sure the read-through from the kind of the skyrocketing gold price should be, we're worried about something in the macro economy, or we're worried about debasement sort of activities. I think it may be as sort of simple as, probably two things. One, there is definitely extra central bank demand for gold right now. Like that is, we can look at central bank balance sheets and see that there's a little bit of extra buying activity there. And then just a momentum trade. So, we do get retail investors, you do get sort of momentum traders come in when you have such an explosive move one way or the other. And so we do think that is, those two things are probably playing at hand. Just don't think it was anything really that was sort of evil lurking underneath the system. We don't think the gold price rise was telling us anything about that, really.
Okay, Scott, good stuff. Thanks so much. We'll leave it there. Scott Ladner is Chief Investment Officer at Horizon, joining from Charlotte, North Carolina, here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.